All right, to begin, we're going to actually talk a little bit more about the vocabulary side of adjusting entries, knowing that there's accrual and deferrals. Okay, types, meaning is the cash on the table and the event hasn't happened, or vice versa, has the event happened and cash is yet to come. We're going to go through exercise 3-4 on textbook page 138, and I believe you'll have to write them in your notebooks. And then we'll get into type, like actually doing some adjusting entries. So before I flip out of here, I just want to review this. This is going to be really helpful when we work through this exercise. Remember, deferrals, the money's here. We're deferring the event until a later time. Accruals, the event has occurred, but the money is starting to pile up, and the money will come later. Okay, so this is going to be a really helpful page to have in front of you as we do this exercise. In this exercise, they're going to list entries. So on page 138, do you see how Hart Corporation encounters the following situations, 1 through 11? And they're basically situations trying to figure out if it's a deferral or an accrual, and if it is it revenue-based or expense-based? So for all of them, we have to decide if it is a prepaid expense or unearned revenue, or if it's an accrued expense or an accrued revenue. The first two are a deferral. The second two obviously are accrual because it's part of their names. Remember, the deferrals, the money is there. For the accruals, the event is there. Okay, so just knowing how to answer all 11 of these, I thought let's just get them listed right there, front and center. So the first one. Hart collects $1,300. Can I just stop right there and say that there's money on the table? Okay, so we know it's not the accrued. We just have to figure out which one it is. Hart accrued or collects $1,300 from a customer in 2014 for services to be performed in 2015. The answer is what? Unearned revenue, and I would like you to put a D behind that, because that's deferring the event. This is a liability. Why is it a liability? What do we owe in this case? We owe the work to be done. We owe the service. Number 2, Hart incurs a utility expense which is not yet paid in cash. Is there money on the table? No. So I'll say that again. Hart incurs a utility expense which is not yet paid. Think about that. The lights are on right now in our school. They might not pay the utility bill till next month. Just like you're using your cell phones right now, but you might not pay your cell phone bill until the next month. Okay, so is it the D or the A side of things? A, and it's accrued expense. The event has happened. In this case, the lights are on. Utilities are being used, okay? But we might not pay the bill till the next year or next month. Number 3, Hart's employees worked 3 days in 2014 but aren't going to get paid until 2015. You guys, that happens all the time in payroll. You might work 3 days before the end of the year and you might not get your paycheck till the next year. Well, we still have to account for that. Is it D or A? Has the event happened or have we paid? It's definitely A, and it's accrued expense, and it's payroll related. It's happened. Our employees have worked 3 days, but they're not going to get paid until the next fiscal year because of how time happens. So we have to expense out those 3 days and then let a payable occur. Later, we're actually going to pay them. Number 4. Hart performs services for customers but has not yet received cash or recorded the transaction. Is there cash involved, or has the work occurred? The work has occurred, but we've not yet received cash. So it's an accrued revenue, meaning we've done the work, this AR hasn't paid. Is this helping? I hope. Can you see how this would be a really good one to have as a desk copy as we do the transactions? Hopefully. Number 5. Hart paid $2,400 rent. I'm going to stop right there. It's a deferral. I have money on the table, and what did we pay? We paid rent on December 1st, and we've actually prepaid it for 4 months. So it's a deferral in the form of a prepaid expense. We've prepaid 4 months worth of rent. Do you think people do that very often, or do you think they pay month by month? I'd say it's more often than it's month by month. But I'll use one example. When I used to rent a storage unit, I would prepay for like 6 months at a time just to have it done with. So that's deferring the use of it. I'm prepaying for it. I'm just deferring the use of it. And as the months go by, I have to adjust for, okay, I used some of it. Number 6, Hart received cash. I'm going to stop right there. I know that's D for deferral. For future services and recorded a liability until the service was performed. What's the liability when we owe work? Unearned revenue. We got the cash. We just now have to do the work. It's just like the dentist example from last chapter. You go prepay for some dental work to be done, you better hope that dentist is going to do the work. Number 7, Hart performed consulting services for a client in December of 2014. On December 31st, it had not billed the client for services provided of $1,200. So we did work. We just have revenue that has accrued. The AR, just like last time, hasn't paid the bill yet. Time period assumption tells me we have to record that revenue for 2014, whether that AR pays us or not. That revenue happened in December of 2014. We might not reap its benefits financially until 2015, but it happened in 2014. Number 8, Hart paid cash for an expense. I can already tell that that is a prepaid expense. What's being deferred? An asset until it's used up. I would guess that that's prepaid insurance. We're going to use that insurance as we go. That's kind of a vague one. What made it really easy? Paid cash for an expense. Well, if you have an expense that's going to happen over the course of time, we're prepaying it. Number 9, Hart purchased $900 of supplies in 2014. At year end, 400 of the supplies remained unused. So my question is, what did we use? Started with 900, we left with 400. We used up $500 worth. Those are a prepaid expense. Basically, we prepaid for those supplies and we expense out what we used. $10 and $11, try them on your own while I scroll to get the answers. Try 10 and 11 on your own. The bigger thing is you got to figure out if cash is on the table or not. I left the two hardest ones for you, didn't I? Hart purchased equipment on January 1st. The equipment will be used for 5 years. It's just like these supplies, you guys. You buy your pile of supplies and you use them over the course of a year. You're basically prepaying for that expense of, as you use them, they become expensed. You'll learn that as equipment loses value, there's a word that's assigned with that. Does anyone know what the word is? You got it, depreciation. Okay, we'll spend a whole chapter on depreciation, but the chapter introduces it to you here. Your cars depreciate by the day. Your cars depreciate the moment you drive them off the lot. Okay. Finally, number 11, Hart borrowed $10,000 on October 1st, signing an 8% one-year note. Okay. While there's money on the table, it's an accrued, there's not money on the table. It's an accrued expense. Hart borrowed $10,000. And what's happening from October 1st to December 31st, we have interest accruing. We're not going to actually pay that note back until October 1st of the next year, but there's interest piling up. And that's what we have to adjust for how much interest we've accrued. Woo! I thought that was a good exercise to just kind of recap what we did yesterday. Now let's actually get into some journal entries. Can you guys go to page 103 in your textbook? On page 103 is basically the same thing as this little table that I put in your notes. Okay, it's just a snapshot of all of the different kinds of adjusting entries, deferrals, accruals, and examples of each. What we're going to focus on today, and if you go to the next page, page 104, adjusting entries for deferrals. That is what we're going to focus on. So deferrals are when the cash is here, the event is not. Okay. Why do we have to adjust? Because from the time the cash showed up until the end of the fiscal period, some or all of the event has chipped away. Just like I'll keep using my Sun Tribune example. I went and paid nearly $200 for an ad to be run in the paper 2 weeks. Well, as the ad ran the first week, part of their work that they owed me was fulfilled. And so from an accounting perspective, I'm not, finalizing my books every week. I do it once a year. So in some ways that's maybe a bad example, but it shows that it chips away at the work as it happens. Okay. I'm going to use page 104 over to page 105 and 106 and even 107 to get us through this. We're going to get through this, and that's where we're going to stop today. Okay. I'm going to read to you the top of page 104. To defer means to postpone or delay. Okay. Deferrals are expenses or revenues that are recognized at a date later than when the cash was originally exchanged. You can either have prepaid expenses or unearned revenue. In unearned revenue, they've prepaid for it. It is an AR, excuse me, not an AR. It's someone has given us money. There's a liability that we have to fulfill to get it done. Money has been on the table. Our work or using up of the expenses is what will take time as the event plays through. I believe these are in your notes. Oh, this is just basically what I read to you. We're going to come back to that one. Is this in your notes? Fabulous. For each, there is a journal entry. I'm going to make T accounts, and then we'll actually do the journal entry. Okay, cool? We'll get through a few of them. If I go back to this, I believe this is also in your notes. Here's prepaid expenses. This is just one example. Okay, so that means money has been there. The event will happen over time. Here are some examples. You prepay for your insurance, usually a year in advance, maybe 6 months in advance. You go buy your pile of supplies. You maybe prepay for advertising. Maybe you prepay half a year worth of rent, and your equipment depreciates or loses value. I'm going to give you a more real example. Last week, I'm pleased to say, I prepaid for my number 9 Kenny Chesney concert that I will be going to in May. I'm a super freaky fan, okay? Don't tell the security at US Bank about me because I may work my magic, okay? I went and bought my tickets last week because I'm a Kenny Chesney fan club member and I got access to the concert tickets before the general public. What does Kenny Chesney owe me? The concert, okay? So I could look at this as prepayment of something, and then when it happens, it becomes fulfilled. If you have season tickets to the Vikings games, same thing. You prepay for them, and you hope that you get to go. Okay, another one would be magazine subscriptions. Okay, you prepay for a year's worth, 2 years worth of a magazine subscription to come to your house every month. And then as the magazines arrive in your mailbox month after month after month, you adjust for that. Now, you'll typically debit the expense and you'll credit whatever asset it is that you own. Because as you use up insurance, as you use up supplies, as you use up your equipment, that asset is going down in value because you're expensing it out as you use it. This is a big one. If I didn't adjust or tell the accounting books what I used, it would look like I have more assets than I really do. I'll use the paper example from school. At the beginning of the year, Lenora gets a lot of paper. She's making a lot of copies. Does she use some of the paper? Absolutely. But if we don't adjust, it's going to look like Lenora has way more paper than she really does, overstating that paper or supplies account. And then it's also going to look like expenses were understated. Or in other words, we didn't have much of a supplies expense. So again, Lenora's paper example is my best one that I can share. Lenora is going to use paper in her photocopy room, hands down. And if we don't adjust, it's going to look like we have more assets than we really do. The paper's gone. And if we don't adjust, it's going to look like the paper's still there. And then as a result, expenses would actually look lower than what they should be. Because as Lenora uses paper, we have to expense. So expense would go up, supplies would go down. Let's try this now. Pioneer Advertising Agency purchased supplies. Circle that one. Highlight it, do whatever you need to do. We bought supplies costing $2,500 on October 1st. Supplies are an asset. Debits on the left, credits on the right. We bought $2,500 worth of supplies on October 5th. Okay. Can we assume we already journalized that? Yes. We journalized that already. I'm just telling you like that's the balance. They recorded the payment by increasing the debiting the asset account. They either paid for it on account or paid for cash. We're not worrying about that. We've already got the asset sitting there. This account shows a balance of $2,500 on October 31st. Well, yeah, of course it does. In the trial balance, it shows that we have $2,500 worth of supplies. That is not true, though, because we haven't done the adjusting entry. Our little minions haven't counted our supplies. After the minions counted the supplies on October 31st, it actually revealed that we only had $1,000 of supplies still on hand. So although the trial balance shows $2,500, that is not true because we haven't done the adjusting entries to prepare the financial statements. That's why we do them. So our minions counted, and they show a balance of $1,000. Where did the $1,500 go? We used it. So if we use $1,500, am I going to debit that or am I going to credit that to get 25 to equal 1,000? Debiting or crediting? Crediting, $1,500 is what we used throughout the month. Well, accounting tells me that if I have a debit somewhere, the other one has to be a credit. And if I have a credit somewhere, the other one has to be a debit. So to journalize what we used, here's my credit. This other account has to be the debit. The other thing is, I know that supplies is an asset. That's a balance sheet account. What does this one have to be? What you learned? It's got to come from the income statement. So not only do we have the debit and credit rule, now when we adjust, we have one coming from the balance sheet, one coming from the income statement. Well, there's only two things that can come from the income statement: revenues and expenses. Well, we didn't make money on using our supplies. We expensed out. What account are we going to expense out? The supplies expense. A new little term, and I forget if the chapter talked about it. The supplies expense account is what's called a contra account to supplies. Did the chapter talk about that? I bet it did. So there, my friends, is your transaction. A debit to supplies expense, a credit to supplies, to tell the story of what happened. There's the transaction that I'd like you to write down. That's what I circled in red. It was a debit to supplies for $1,500. And supplies lost value by $1,500 because we used them. Now here's the trick. The trial balance showed a value of $2,500. That is not true because that is not what is still sitting in our account. That's why we have to adjust for what we used. Can you see where students would make an error here? Could you see that they'd put 1,000 in here instead of 1,500 because that was the number that was given? But that's why I do the T accounts, to show you that that's what's still on hand. This is a deferral, and it's considered one of the prepaid expenses. It's basically, we're buying these supplies, we're prepaying that, we're expensing them out as we use them. Maybe you were feeling good, like, I got this. Now you're maybe feeling like, oh, this is hard. We're going to keep going though. On October 4th, Pioneer Agency paid $600 for a 1-year fire insurance policy. Tell me why that's an asset. What do we own there? What do we own? Do we own 1 year of fire insurance coverage? It's called prepaid insurance, an asset. Okay. Debits on the left, credits on the right. This is a right side of the big T, so it's an asset or debit-based account. So when we bought it, it was $600. Coverage began on October 1st. They originally made a payment by debiting prepaid insurance. Okay, we got it. There's our balance. Now, do we really have $600 on the trial balance? Right now, if we would leave it, assets would be overstated because, folks, we do not really have $500 because insurance is actually costing us $50 a month. So it's losing $50 worth of value as the months go by. So if 1 month went by, because we're doing adjusting entries at the end of October, we lost $50 for the month of October. And they did the math. 600 divided by 12 months is $50. Just for kicks, what's our new balance of prepaid insurance? $550. But hold the show. I had a debit or a credit somewhere. Whether I know the account or not, I better debit for that same amount just to get my debits and credits in there. So I had a credit here. This one has to be a debit. Remember, this is a balance sheet. This one has to be from the income statement. Well, if I use something up, what word could we probably put with that? Expense. Insurance expense. I hope the T accounts aren't confusing you. I hope they're helping you because you visually see a debit and a credit and where they came from. Journalizing, it's actually pretty easy. We debit insurance expense for $50 and we credit the asset because we lost part of the asset as we used it for $50. Again, it's a deferral adjusting entry because we're deferring the event as it happens. Cash is at the table right away. And as we chip away, the prepaid expense occurs. So month by month, we're going to lose a little bit of that asset value and have that prepaid expense occur. Oh, did I get ahead of myself there? Oh, shoot. That's the rent and magazine subscriptions. Wasn't rent on the other one too? My Kenny Chesney concert, this is Kenny Chesney's books. Because right now I'm one of his liabilities. He owes me a concert. Does that make sense? The magazine subscriptions are if I'm selling magazines. If Junk by Jenny has a magazine subscription, wouldn't that be something? Oh man. Okay, and I'm selling those, and as I send out magazines. The other one was like if I were the one buying the magazines. This one is like Kenny Chesney is, I'm one of his unearned revenues. He hasn't done the work for what I paid for yet. With unearned revenues, again, money is on the table, the event is deferred. If we didn't run the adjusting entries, it would look like we owe more than we really do. In other words, liabilities would be overstated and revenues would be understated. Let's use this example of the Kenny Chesney concert. I bought tickets to his concert last week. He's not going to fulfill his liability until 2018 when I go to the concert. And if we didn't run adjusting entries, it would look like he has a bigger liability than what he really has. When he performs the concert on May 5th, the liabilities will go down and his revenue will actually be earned. He can't say that he earned revenue yet. Rather, he's got a liability hanging there until he performs the concert. That's important to understand because that's on the test. Things like if a magazine subscription is not adjusted, liabilities will be, and you might have an answer that says overstated or understated. You've got to know that. Like, just know that the trial balance is not the accurate story. You have to adjust for what was used or what happened. Otherwise, things would be all out of whack. So let's do a couple of them. Notice the debit will always be a liability of some sort. And the credit will be a revenue. And this one's an easy one. You're turning unearned into earned. Unearned revenue and revenue. You're getting rid of this liability that you owe, and you're turning it into actual revenue that you've earned. Turning unearned into earned. That's what this one is. Let's do the example. Pioneer Advertising received $1,200 on October 2nd from RNOX for advertising services expected to be completed by December 31st. So this is just like my Sun Tribune example. I prepaid them, they needed to run my ad. Okay? The difference here, instead of over 2 weeks, it's going to be over October, November, and December. It's going to be over 3 months. Unearned service revenue shows a balance in the trial balance of $1,200. So we've got unearned service revenue, which is a liability. What does Pioneer owe RNOX? What's a liability here? If RNOX prepaid $1,200, what does the advertising agency owe? running ads, whatever they're doing, running ads in their newspaper, whatever, running ads in their, they owe them work, okay? Now the trial balance says that this is what's there. That is not true. We have to adjust for what was used. Analysis reveals the company, so this company performed $400 worth of work in October. They did, out of the $1,200 that was prepaid, they did $400 worth of work. I want to change pen colors here. What do they owe yet? $800. That doesn't matter though, because $400 worth of work they did. They reduced what they owed, okay? Well, I see a debit somewhere, so I don't even care what the account is yet. I'm going to credit the $400 because I know that's debit and credit rules. I see a debit, so there's got to be a credit. To what? When unearned becomes earned, it's called service revenue. This was a liability, so that's coming from balance sheet. Service revenue is definitely part of the income statement. And this transaction is turning unearned into earned. It's the dentist example of I'm prepaying for dental work. It's the Kenny Chesney example, I'm prepaying for concert tickets. Kenny, you owe me a concert. And as that liability is performed, it turns the unearned liability, you've not done the work, into earned. And so what you see in green, what I'm going to circle in red, is the transaction. Unearned of 400 is reduced, that liability is reduced. Not fully, they still owe $800 worth of work. And service revenue then can be set at, woohoo, they made $400 worth of money. What are some other industries where they prepay for stuff? Can you think of any? Lawn care, maybe? Do you think the school maybe prepays for like the lawn to be mowed all summer? Maybe. I don't know for sure. Snow removal? The tricky one there is how it depends on how much it snows, really. Woo! That got us to the end. Now tomorrow, we're going to talk about work happening, but we're deferring. I shouldn't use the word defer. We're postponing the payment. Hopefully this helped. In the past, I've had classes say, I don't like the T accounts, but I think they show the full story. I feel like the T accounts are really helpful. If you're kind of feeling shaky and very unsettled at this point, trust the system. By this time next week, you're going to be like, I'm ready for the test tomorrow, because a week from tomorrow is the test. We'll be okay.